All right, folks, welcome back to the channel. Grab your coffee, settle in, because today we're talking about something that goes way beyond the usual market chatter. We're not just talking about a 2-5 basis point hike or a dovish pivot. We're talking about a political earthquake that's shaking the very foundations of the American financial system. You see, for the last century, there's been a sacred unspoken rule in Washington. You do not mess with the Federal Reserve. Presidents can complain, they can tweet, they can whine, but they don't try to rip the institution apart. Well, the rule book just got thrown out the window. We are witnessing an unprecedented bare-knuckle brawl between Donald Trump and the Federal Reserve, specifically targeting one of its governors, Lisa Cook. And let me be crystal clear, this is not just another political drama for the 24-hour news cycle. This is a calculated attack on the independence of the world's most powerful central bank. It's a move designed to inject a permanent political risk premium into every single US asset you own. Today, we're going to dissect this constitutional crisis in the making. We'll peel back the layers of the official story to reveal the real, high-stakes game being played, and most importantly, we'll figure out what this means for your money and how to navigate a world where the Fed's credibility is no longer a given. This is a big one. Let's get into it. The shot across the bow. How to fire a Fed governor. So, how did we get here? This whole saga kicks off not with a bang, but with a bureaucratic paper cut. A man named Bill Pulte, a Trump appointee at the Federal Housing Finance Agency, files a criminal referral to the Department of Justice. The target? Fed Governor Lisa Cook. The accusation? Mortgage fraud, allegedly committed back in 2021, before she even joined the Fed. The claim is she listed 2 different properties as her primary residence within a few weeks to secure loans. Now, almost immediately, Trump pounces. He gets on Truth Social and demands her resignation. Then, on the 25th of August, the bombshell drops. A formal letter of termination citing this mortgage allegation as cause to fire her, effective immediately. Cook, the first black woman to serve as a Fed governor, fires right back. She calls the allegations baseless, rejects the president's authority to fire her, and declares, "I'm not going anywhere." Her lawyer calls the move illegal and promises a lawsuit. The Fed itself, in its typically reserved tone, basically says, "Governor Cook is still here, we value our independence, and we'll see you in court." But let's pause here. The process is the story. This wasn't a policy dispute. This was a targeted administrative strike. An official from one government agency was used to create a legal pretext, a fig leaf, really to oust an official at another independent agency. It's a chillingly clever strategy. It bypasses the messy political debate about interest rates and reframes it as a clean, simple issue of legal wrongdoing. This is a massive escalation from Trump's old playbook of just publicly calling Fed Chair Jerome Powell an enemy. This is a procedural attack on the institution itself, and it sets a precedent that is infinitely more dangerous than angry tweets. What does "for cause" even mean? Now, the legal eagles are having a field day with this. The Federal Reserve Act of 1913 does say the president can remove a governor for cause. The problem is, in over 110 years, no president has ever actually tried it. For a century, for cause was understood to mean serious misconduct while in office, not something that allegedly happened before you were even appointed. And it requires due process, a hearing, a chance to respond. None of that happened here. The Trump administration's argument is a sweeping interpretation of presidential power. They're basically saying the Constitution gives the president broad authority to fire officials, period. Their lawyers are likely feeling pretty good, given that the current Supreme Court has been friendly to expansive views of executive power in other cases. Cook's defense rests on the idea that the Fed is special. It's a quasi-private entity, as the Supreme Court itself has hinted. Congress deliberately gave governors those ridiculously long 14-year overlapping terms for one reason: to insulate them from short-term political pressure. So, the real fight isn't about whether the for cause clause exists. It's about who gets to define it. Trump is essentially declaring that he is the sole arbiter. This is destined for a Supreme Court showdown that will literally define the boundaries of political power over the central bank. A century of de facto independence built on norms and restraint could be replaced by a sharply defined, court-mandated legal definition. The Fed's autonomy could go from being a revered tradition to a legal footnote subject to the political whims of the judiciary. The real game, 4 reasons why this is happening. Okay, so that's the what, but we're here for the why. The mortgage fraud story is the smokescreen. Let's look at the 4 real strategic objectives behind this unprecedented attack. First and most obviously, it's about the rates. Trump has been on a relentless crusade against Jerome Powell for not cutting interest rates. He's openly mused about firing Powell His goal is to reshape the Fed's Board of Governors. If he successfully replaces Cook, his appointees will have a 4-3 majority. It's a hostile takeover, boardroom style. This move against Cook sends a chilling message to every other governor. Defy the White House on policy, and we will find a way to destroy you personally and professionally. It's a tactic designed to create a chilling effect, forcing the Fed to self-censor. Second, it's about the national debt. This is the macro-level reality that underpins the politics. High interest rates make it incredibly expensive to service America's colossal national debt. With massive structural deficits and no political appetite for raising taxes or cutting spending, lowering interest rates is the politically easy way out. It's a temporary fix that frees up fiscal space without making hard choices. This creates a massive incentive for the White House to stop seeing the Fed as a guardian of price stability and start seeing it as a tool for debt management. This is the classic path to high inflation and economic instability you see in countries with weak central banks. Third, and this is where it gets really juicy, it's about the personal portfolio. Recent financial disclosures show that since taking office, Trump has personally purchased over $100 million in corporate, state, and municipal bonds. The financial logic here is brutally simple. Bond prices and interest rates move in opposite directions. When the Fed cuts rates, the value of existing bonds, especially those bought at higher rates, goes up. Cha-ching. This provides a clear, powerful, and personal financial motive. It transforms an abstract debate about institutional norms into a very concrete story about a president potentially using his power to enrich himself. And fourth, this is about installing an architect for a radical new agenda. Trump has already nominated his economic advisor, Stephen Miron, to fill another vacant Fed seat. Miron is not your typical economist. He's the brain behind some truly radical ideas, including the so-called Mar-a-Lago Accord. This is a plan to devalue the US dollar by essentially strong-arming foreign central banks using threats of tariffs and pulling military protection into swapping their US treasuries for ultra long-term or even permanent US bonds. He's an open critic of Fed independence and has co-authored papers arguing the president should be able to fire the Fed chair at will. Focusing on just a rate cut misses the point. Miron's nomination reveals a much grander, more audacious plan. The goal isn't just a dovish Fed, it's a subservient Fed that can be used as a tool in a broader geoeconomic strategy. It's about weaponizing the dollar and US debt to achieve trade and geopolitical goals. Putting Miron inside the Fed would be like planting a demolition expert in the basement of the building. The fight over Lisa Cook's seat isn't just about the next 25 basis points. It's a fight for control of the institutional machinery needed to execute a fundamental reset of America's role in the global financial system. The fallout, the Wile E. Coyote moment for markets. So what happens when you systematically dismantle the credibility of your own central bank? First, you get a credibility deficit. Fed credibility is like the foundation of a skyscraper. You don't see it, you don't think about it, but if it cracks, the whole thing comes tumbling down. If bond investors lose faith in the Fed's willingness to fight inflation, they will demand higher interest rates on US government debt to compensate for that risk. That pushes up borrowing costs for everyone. This is exactly what's happening. Every attack, every nomination of a loyalist signals that future policy will be driven by political cycles, not economic data. And this creates a permanent inflation and political risk premium on all US assets. Second, you create a dangerous divergence between Wall Street and Main Street. We're currently in a tricky economic spot, a sort of quasi-stagflation with slowing growth and sticky inflation. Now, a politically motivated rate cut would be like pouring gasoline on the inflationary fire. The market, in its infinite short-term wisdom, is obsessed with rate cuts. A cut would pump liquidity into the system and likely cause a short-term asset price rally, a sugar high. But if the underlying disease is stagflation, cutting rates is the wrong medicine. It juices asset prices while inflation erodes corporate earnings and consumer purchasing power in the real economy. This sets us up for what I call the Wile E. Coyote moment. You know, when the cartoon character runs off a cliff and keeps running on thin air, not falling until he makes the mistake of looking down. The market is Wile E. Coyote, running on the air of cheap money, completely detached from the eroding economic fundamentals below. When it finally looks down, the crash could be spectacular, made worse by the fact that the Fed will have already wasted its ammunition rate cuts for political reasons, leaving it powerless to fight a real recession. So, where does that leave the odds of a cut? The CME FedWatch tool, which tracks market bets, shows the probability of a September rate cut soaring to around 90% after Powell's recent Jackson Hole speech. The economic data is softening, yes, but it's still mixed. Inflation is still stubbornly above target. A purely data-driven Fed wouldn't be a 90% lock for a cut. What that 90% tells you is that the market is no longer just pricing in economic data, it's pricing in political pressure. It's making a political bet, not an economic one. And that is a very dangerous game. Your playbook, how to invest when the rules are broken. Okay, so the world is getting crazier. What does this new paradigm of stagflation risk and political risk mean for your portfolio? Let's break it down by asset class. For stocks, be wary of the sugar high. A politically driven rate cut could spark a relief rally, especially in growth and rate-sensitive sectors, but the medium-term risk is huge. If the cut is a policy error that unleashes inflation, the subsequent crash in fundamentals could be brutal. The strategy here is to focus on high-quality companies with genuine pricing power, businesses that can pass on higher costs to consumers and be ready to trim risk into any liquidity-fueled melt-up. For bonds, the yield curve is the key battleground. A rate cut will push down short-term yields. But here's the paradox. The loss of the Fed's inflation-fighting credibility could cause long-term yields to actually rise, as investors demand a higher premium for the risk of future inflation and institutional decay. This points to a steepening yield curve. The play is to favor short-term bonds and be very cautious about long-duration government debt. For the US dollar, the outlook is structurally bearish. You have the combination of falling interest rates and an administration, via thinkers like Stephen Miran, that openly desires a weaker dollar to boost exports. The long-term, unchallenged reign of the dollar as the world's sole reserve currency is now officially in question. This is no longer a fringe tail risk, it's a central part of the conversation. Finally, this brings us to gold and hard assets. Gold is uniquely positioned for this environment. It's the classic hedge against inflation and currency debasement. But more importantly, in this specific context, it is the ultimate hedge against institutional decay and political instability. In a world where faith in central banking itself is being shaken, gold's role as a non-sovereign store of value becomes paramount. It's a bet against the idea that the people in charge have everything under control. So let's sum it up. If the Fed caves and cuts aggressively, you can expect a short-term pop in stocks followed by a painful reckoning, a sell-off in long-term bonds, a weaker dollar, and a strong rally in gold. If by some miracle, the Fed holds the line and remains data-dependent, you'll likely see stocks fall as recession fears mount, a rally in long-term bonds as a safe haven bid kicks in, a stronger dollar, and a more muted but still positive performance for gold as a hedge against that potential recession. The bottom line is this. We have entered a new era. The political weaponization of the Federal Reserve isn't just noise. It's a fundamental shift that adds a new, volatile, and unpredictable layer of risk to every single investment decision you make. The anchor of global finance is coming loose. Make sure your portfolio is ready for the storm. What do you guys think? Is this a constitutional crisis or just politics as usual? Let me know your thoughts in the comments below. And as always, if you found this breakdown valuable, hit that like button and subscribe for more deep dives. Stay sharp, stay diversified, and I'll see you in the next one.